Hey everybody, welcome back to the channel. This is the official Palantir Q2 2023 review and my thoughts on what we got from earnings. I'm not going to share my screen, not going to be showing too many of the numbers. You probably have already seen the slide decks. I'm going to be going through and dissecting, and there will be timestamps in the description, the four biggest things from this earnings call that I want to discuss and that I wanted to talk about, and basically talking about my thoughts on all four of these things, some of them good, some of them great, some of them not so great, and discussing what I believe is the trajectory for the company now, given the earnings call that we got. First off, before we get into it, I just want to thank the 5,800 people that showed up for the live stream. I mean, that was just, I did not expect that. So thank you so much for showing up to the live stream. I know there's a lot of new subscribers on this channel. If you're new, I make Palantir content. It's the most interesting, exciting company in the world. I like covering the company. There's a unique philosophy around it. There's a unique technology around it. It's something that I get excited to talk about. It's just, I don't get excited to wake up in the morning to make videos about Coinbase. It's Palantir. So as a result of that, you can expect more Palantir content on the channel. And if you are not following me on Twitter, make sure you follow on Twitter. Dan Ives will be doing an official Twitter Spaces with Arnie and myself. Arnie's another person in the Palantir community at 5 p.m. Eastern on Friday. So if you're not following on Twitter, make sure you check out the Twitter in the description. 5 p.m. The Twitter Spaces was already up there. You can set a reminder. 5 p.m. audio, Twitter Spaces. It'll be fun talking to Dan Ives, one of the biggest investors / analysts, equity analysts on Wall Street. So it'll be really fun to discuss and talk to him. All right, let's get into earnings. High level thoughts before I get into the deeper segments that I want to get into. Number one, I thought earnings was not great, and I thought earnings was not bad, meaning earnings are relatively good. They're relatively average. We did not blow it out of the park. We did not have some insane guidance raise, insane revenue beat, none of that. It wasn't an NVIDIA type of quarter, but it also wasn't a quarter that makes you think, oh my God, what am I doing investing in this company? This is the worst thing I've ever invested in. And so as a result of that, I thought the quarter was relatively average, even maybe better than average, given some of the qualitative stuff we're going to talk about that isn't really reflected in the numbers you see in the financials. And that requires a little bit of risk taking as an investor to interpret some of those numbers, but that's what I want to do in this video, which leads me to believe overall that the quarter was pretty good and the quarter was not one of the worst quarters in the world. Now, going into the quarter, what Wall Street expected was a 14% decline or upside gain on the shares in terms of appreciation because of how volatile this stock has been over the past 3 months. It was up 183% going into yesterday. And so the idea was, look, if Palantir does not absolutely kill it, there is no way the street is going to let them justify their valuation at $40 billion, 20 times price to sales. And so the street's going to tank it. And that's not what happened. The street tanked it by like 10% for a little bit. It was down at $15.80. And then immediately it rose up and got green after hours at $18.43. Right now, Palantir is about $17, so it's down 5% for the day. I was expecting if we did not hit it out of the park because of the valuation stretch, maybe the street would send us back to 13 or 14 because there's just no way they could justify it. I was wrong on that, and I was pleasantly wrong on that. And in this video, I'm going to explain why I was wrong on that and why I think the street is still giving Palantir the premium and believing that this is a company that is one of the most exciting companies in the world and has a long trajectory of growth coming up in the future. So first thing I want to talk about is revenue and EPS. We are GAAP profitable, 1 cent of profitability. Management basically said we are going to be GAAP profitable for the rest of the year. And so we can expect to be in the S&P 500. There were many times where the CFO or Alex Karp, the CEO, mentioned the S&P 500 index. And so they were being pretty explicit to shareholders, like, you can expect us to be inside of the S&P 500 because we're not going to mess up when it comes to GAAP profitability. And I trust them on being able to deliver on that, specifically because of US commercial growth. Revenue, $533 million. They guided 528 to 532. So it was a $1 million beat. Totally fine, nothing crazy. I pretty much expected 533 million. I did not expect 550 like some of these analysts that were expecting to, in my opinion, pump up the stock for no reason, for whatever they wanted to do. But 532 or 528 is what management said. We got 533. That's not bad at all on the high end of guidance. And that's 13% year-over-year revenue growth. Now, 13% year-over-year revenue growth is not the 30% CAGR we were promised a while ago. I'm going to go a little bit more deeper later and discuss why that 30% possibly is coming and why it's kind of important as a shareholder to understand why the revenue growth is not as strong right now. But in terms of GAAP profitability to be included in the S&P 500, which management on a fiscal responsibility level really wants to get to, and revenue beat, it was fine on that perspective. It was nothing crazy, definitely not bad. We didn't miss. Overall, we came in with expectations, which is pretty good. Okay, second thing I want to talk about here, customer count. So we increased our customer count by 8%, which is really important because for the past 4 quarters, we have been declining in customer count acceleration. So I think we went from like 15% to 9% to 7% to last quarter was 6.5%. That means quarter over quarter, we only grew customers by 6.5%. Why is this important? If we're not growing customers, given Palantir's unique business, they're not able to generate revenue. They're not a company that can just say, hey, here's a million organizations can just download this product and pay us $20 a month. That's not how the product works. It's a very highly customized product that's working to solve a massive problem within an organization. And as a result of it solving a problem within that organization, Palantir is able to then solve problems for many other organizations in many other industries. But that requires customization. That requires forward deployed engineers. That requires a bit of consulting. And so as a result of that, you have to increase customer count because Palantir doesn't get paid off new customers until 12 to 18 months after they acquire them as a customer. They need to get into their organization, they need to deliver the solution that matters, and then they need to scale and be able to monetize after they've done that. And that's not the easiest thing in the world to do, but you need the customers in order to even have a chance to be able to generate the revenue. And so we finally got to 8% customer count growth quarter over quarter, which is a reacceleration of growth. Hopefully next quarter we see 9 or 10%. That would restore confidence that management is able to lock in these deals and lock in these customers. And now we're at 421 customers. Last quarter we were at 390. So that is an overall good thing. If we did not have a reacceleration of customer growth, I think a lot of people would be very worried in terms of what is going on. We understand sales and marketing is not the best. We understand you guys, are not a snowflake when it comes to sales, and you're spending so much of your Snowflake's spending 70% of revenue on sales and marketing. We know you're not at that level yet, but if you can't sell the product and you get at least some new customers that you got from last quarter, it puts more doubt into the ability for the product to even scale. So it's a very good thing that customer count reaccelerated. I think Palantir had a keen focus on that, and that was the biggest thing. If you saw my earnings expectation video, the day of earnings, that's the only thing I cared about, quite frankly. I was like, look, even if the street tanks it, like what I care about is can we make sure customer count is in line? Because if that's the case, then things are going to be okay. So that came in at 421 customers, up from 391, which I thought was very good, and ultimately should pave the way to lead customer growth in the future. Next thing I want to talk about is AIP. So AIP, I've started to discover, is basically the crown jewel of Palantir and the AI story over the next 5 years. AI enterprise spend from Bloomberg is going to be 4.4 trillion by 2032. Okay, so Bloomberg and all these other stories and all these other news articles and Gartner and all these information think tanks are telling me there's going to be trillions of dollars spent in AI. That's what's going to happen. NVIDIA Jensen Huang, CEO, just did a keynote today saying the generative AI revolution has begun. So it's happening. If I accept that premise, the question then becomes how much of that market can Palantir take? Because at the end of the day, if there's $4 trillion being spent, I don't need you to get all 4 trillion. I don't need you to even get $1 trillion. I don't even need you to get a couple $100 billion. I just need you to get maybe a couple tens of billions, because the multiple on you being able to generate that much revenue will make the company worth a couple $100 billion, and I will have a 10x on the company, right? That is the sort of pathway I see in the next 7 to 10 years to be able to generate a return on this company, and a return that is, pretty substantial at that. In order for that to happen, AIP, their flagship product, has to be able to scale. And the two qualitative pieces of analysis we got from CARP, which were not in the financials, probably not in the 10K. So it's important to understand this as like an actual shareholder when you're listening to the call, is 100 organizations are already using AIP. So 100 customers, and I don't even want to call them customers, call them pilots. They're like in the pilot stages of it's in their organization, they're using it. In those 100 customers, Palantir has deployed that in the past 10 weeks. So in the past 2.5 months, they got 100 pilots onto AIP. They have 5,000 users using AIP, 5,000 users across 100 different enterprises, that it's growing 50% month over month, which is what Shyam Sankar said, which means theoretically, if a lot more employees are engaging with AIP, that user growth should be even higher, and those 100 pilot contracts should turn into legitimate contracts. Some of those companies are Jacobs, Dish, they were showing this in the deck, Cleveland Clinic, Tampa Bay General Hospital. Some of the companies that have already performed at the AIP conference were basically the dog whistle to the fact that AIP is starting to spread across the existing customer count that Palantir has. The next piece of analysis here that was very interesting was that 300 additional enterprises are in talks with Palantir to be able to implement AIP. So you've got 100 using it, and you got 300 in the pipeline. You've got 421 overall customers, which means 400 out of 421 are potentially going to be using AIP. And none of it is monetized yet. I mean, Karp basically said in the earnings call, we will figure out how to monetize later. So, and by the way, I will have many videos over the next couple of weeks highlighting some specific things from earnings and tackling very different issues and talking about Karp and dissecting the earnings call because I thought there was a lot of good stuff there. But in terms of just today, he said, look, we'll figure out how to monetize this later. Right now, we've got 400, potentially 100 using it, 300 in the pipeline. Eventually, we will have, let's say in the next 3 quarters, 400 in committed contracts. What is the value of each of those contracts? Is it 5 million? Is it 10 million? If it's 10 million, that's 400 million in ARR. Is it? Is it 2 million? That's 800. Like, you know, is that it? Like, what's going on? Or sorry, no, that's 4 billion. If you have 10 million times 400, that's 4 billion. If you have 2 million times 400 customers, that's 800 million in ARR, right? So it's like, what exactly is AIP worth? I would argue AIP is worth at least $1 million. You think of Jacobs, which is a $15-16 billion company, they can afford to spend $1 million on AIP. You have some other smaller customers that probably can't do that. But if all of those 400 clients, even at a minimum, paid $2 million to upgrade to AIP, that is $800 million in additional ARR. Now, this gets, complicated. We can talk about the numbers and how they annualize that, all that stuff. Is that over a couple of years, whatever that is. But right there, we see the monetization potential of AIP that has not been monetized at all. So all of the revenue that they've been able to recognize over the past couple of quarters has been from Foundry, from Apollo, from Gotham, and from government contracts. It seems, the way I'm interpreting their earnings call, is that they haven't begun monetizing AIP. They haven't really established official contracts. This is just in the early stages. And this is exactly what Karp said in the prior earnings call that says, we don't have a pricing strategy. Our strategy is to take the whole market. Once you take that market, eventually, when people see how beneficial AIP is, they are going to be paying whatever we want for it because we are going to have pricing power because of our unique differentiating moat that no one else in the marketplace is able to implement an AI enterprise software platform for your company, for your organization, which is exactly what Dan Ives said on the $25 price target that came out just a week before earnings. It sounded very similar to what he said in terms of who he's talking to and how they think Palantir is the only reference point for AI enterprise platform spends and what Palantir is saying in terms of their ability to expand that massively. So this was a really, really important thing because if AIP did not have 400 customers in the pipeline, you would be thinking, what is the growth of AIP? How can it get there? How can it actually scale? How many clients could actually pay for this? And, do you even have the ability to sell this thing to the marketplace? It's not the easiest thing to sell because yes, generative AI is everywhere, but actually closing those deals and getting people to trust your generative AI platform, which is essentially making sure LLMs are secure and sophisticated within an organization, it's not the easiest thing in the world. And I am very impressed that in 10 weeks of rolling out AIP, Palantir has 400 potential customers ready to pay for this product, assuming in the next 12 months. And that's where revenue growth of 13% year over year to me is not the worst thing in the world. It's not great. It's hard to justify 19 times price of sales and a $40 billion valuation at 13% revenue growth. But, and I'll go much deeper into this in other videos talking a little bit more about network effects and things of that nature. If you believe in the long-term vision, AIP is the Trojan horse that enters into an organization, becomes the de facto product that is going to be the way your operating system, your enterprise operates on top of Foundry, and you can monetize that really easily in the future, and you can monetize that with great pricing power. So that is the long-term vision for AIP, and that's why I can handle 13% revenue growth or 18% revenue growth for the year, because I think we can get to that 30% CAGR over the next couple of years if AIP is able to be monetized, and it seems like it's going in the right direction to get there. So that was the third point. Last point I want to talk about is some of the games that Palantir is playing in the context of Wall Street. So Palantir, I think, made $11 million on net interest income, which is basically getting treasury T-bills. I think they put like $1 billion there and they got $11 million back. And they authorized $1 billion in share buyback. So they did two things that are very Wall Street-esque, which they're playing the game of Wall Street. They issued share buybacks. And on top of that, they put their money, their cash, into T-bills. They have $3.1 billion in cash. They probably put $1 billion there, and they got some interest income, and that is why they were able to get GAAP profitable. So they got to GAAP profitability because of the interest income, and people are arguing they likely saved the stock from tanking because they told Wall Street, hey, we can buy back $1 billion of our stock. Our board has authorized that, which means, if things go really bad, we'll just buy back the stock. And then boom, you have less dilution and you have kind of an artificial floor that's being set on the stock in and of itself. I think these things are brilliant, and I think these things are genius. Anyone who is saying that these are bad things to do or that they don't make any sense, to me, is like being very, very unfair to Palantir. And I'm saying this as someone who I think is pretty objective, okay? In August of 2022, Q3 earnings, when Karp said, Q2 2022, Karp said, we're not going to be profitable till 2025. I made a video, it's on my YouTube, you can watch it, where I said, this is horrible. I was like, you're not going to be profitable till 5 years after you like, what are we, Spotify, Snapchat? What is going on here? We can't be profitable. Like I was really upset. I was annoyed about it. I wasn't selling, but I was just like, this is not cool. And the thing I said in the video was, let's give them the next 5-6 quarters and see what they can do about this, because this is ridiculous. And by the end of the year, 6 months later, they're profitable, right? And so it's, to me, I've been critical of them when it was time to be critical. Not profitable to 25, you deserve some criticism there. But to criticize them because they're profitable now on a GAAP basis because of interest income, and they are doing the financial engineering that Google, Apple, Amazon, all these companies do in order to make sure that their stock stays afloat and they meet earnings per share expectations, which is buy back the stock. Meta's buying back 40 billion, Google's buying back 70 billion, Apple buys $20 billion worth of their stock every single quarter. And they've been doing that for the past 4 or 5 years because it's really hard to grow a $1 trillion company to $3 trillion unless you buy back some of the stock so you can keep the expectations set in terms of its earnings per share. These companies are known to do that. And what is that? That's just playing the game of Wall Street. So the idea that buybacks are bad or that you're only profitable because you're getting your money in interest income, this is what they need to do. And it's so funny to me because a couple months ago or a year ago, the narrative was Palantir is not doing enough to appease Wall Street. And that's why they're hammered at $6, $7, $8. It's a dead company, dead money. They can't move because they're not playing the game of Wall Street. Now, a year later, when the stock has rallied 200% and they're finally deciding, hey, we're going to try to do what we do because we believe that we're a dope company, but we're also going to try to make shareholders decently, at least understand us from a fiscal responsibility perspective and try to keep them happy by playing the game that Wall Street wants, which means we're going to do some share buybacks. We're going to do, money in T-bills instead of investing it in growth right now because T-bills is guaranteed $11 million in net income, and that we can guarantee GAAP profitability so that we can get in the S&P 500, so we can get a ton of institutional exposure so that shareholders can be more happier in the future, so that we can show shareholders we're fiscally responsible. We're going to do all of that stuff, even though we're a unique cultural company that is fundamentally different from other tech companies, and we're going to play the best of both worlds. And now people are complaining. They're like, they're appeasing too much to Wall Street. It's like, if they were not appeasing to Wall Street in one of the hardest macro environments that I've seen at 5% interest rates, this would be a bad earnings, because then there would be no floor to the stock in terms of buyback. There would be no ability for Palantir to be able to say, hey, we're going to be GAAP profitable, because they wouldn't be able to guarantee GAAP profitability. So the concerns that, they should be growing, they should be putting that billion into sales, they should be able to be GAAP profitable without interest income, they don't need to do this $1 billion share buyback at 16, they should have done it at $6. All of that stuff doesn't matter if you look at the macro environment, how hard it is in Q2 for SaaS companies to scale, and then recognize that Palantir is just playing a game that every big tech company is playing. They're just playing it at a strong level because even though they're not as big as Google or Amazon, they're very tiny compared to them, they are still trying to find a way to guarantee shareholder returns and Wall Street happiness with what they're doing so that Wall Street doesn't tank the stock back to $5. Because if there's no GAAP profitability in an interest rate environment of 5%, Palantir is not $18 a share. And so in my opinion, this is actually the thing they needed to be able to do. They needed to be able to show shareholders, they needed to be able to instill confidence within shareholders by doing the things that you do when it comes to Wall Street. And I just have no problem with that. The final thing I'll say is that, people were saying, why didn't they buy back their shares at $6, $7, $8? I thought about it a lot last night. Sean, I talked to him. He had a really good point in the live stream. That would basically be taking shareholder capital and pumping it into your own stock to justify the share price being higher. If anything, I really thought about it. At 6, 7, 8, Palantir was not GAAP profitable. Palantir had excessive stock-based compensation. The potential of the business, there was no AIP, was really in the air. I mean, no one would thought Foundry was just going to take over the world, right? So it was a very company that was just kind of out there, and we didn't really know what was going to happen. For them at that stage to be irresponsible enough to take their cash and put it into their own stock, which would, in the eyes of Wall Street, basically be artificially pumping their stock by using shareholder capital to just buy back the shares to try to pump up the stock when the business wasn't performing, that would have looked way worse than now. Your shares are up organically 200% year to date or 150% year to date, and you've been authorized by the board at this point to take a bet on yourself, even at, you could call it a stretched valuation at 16, 17 bucks, to buy back those shares, which creates a floor to the stock a little bit more easily than if there was no buyback. And you're taking a bet on yourself, and you're believing that if this AI hype cycle is going to continue and we're a major player, 16 is cheap, 17 is cheap. Now, do I personally feel that given the growth? No. But if management thinks that the trajectory to growth is there because they are seeing what's going on in the business and they have 400 customers in the pipeline, and they're like, hey, yeah, it's $16. It's not a bad thing to buy our stock. And at $6 or $7, we weren't at the fiscally responsible level to say, yes, it's time to buy our stock. Then by all means, this is a great thing to authorize your share buybacks. You don't have to do it, which means you can give Wall Street the perception that you will do it if it gets bad, but you don't have to do it if you don't want to, which is really good because you have that optionality. And you get to show shareholders, yeah, if things get really bad, we'll take some dilution off the table by buying back our stock. So I think all of the concerns on this earnings call that I've heard, they're just not strong enough concerns. The biggest concern is lack of revenue growth. That's fine. I'll do more videos in the future for why I think that revenue growth will be coming. But if that's your only concern, GAAP profitability is there. 8% customer count growth is there. AIP seems to have a lot of customers in the pipeline, and it's going to be really exciting as that scales. SBC normalized. It's going to be probably a little bit higher toward the back half of the year, but it was down 30 million from last year's Q2. I mean, buybacks are good, and T-bills and getting interest income is good to ensure GAAP profitability. So at the end of the day, I do not think this earnings was bad, and that's why I think Wall Street is like, you know what? Yeah, we thought we were going to tank you to $8, but as of now, unless anything crazy happens in the macro, which means all stocks are going to have to suffer until then, it seems like Wall Street's fine with a $16, $15, $17. Even if it goes to $14, it was at $7 in May. So we all have to remember as shareholders, the stock is up quite significantly this year because it fell so low. And now there is a world in which Wall Street starts to normalize and consolidates the price here. And then over the future years, this becomes support for price action as it goes higher into the future. Raymond James upgraded the price target to $22 from $18. Dan Ives still has his $25 price target. We got a couple of other price targets around $15 or $10 from other institutions. So it seems like earnings, at least in the eyes of Wall Street, was not the worst in the world. It was definitely exciting for me as a shareholder to see where the potential of AIP can go. And I didn't think it was bad earnings at all. I thought it was actually really good. And that's as objective as I can be. And hopefully this video gave you an objective take on why I think earnings was not bad. And ultimately why I think there's a lot of growth in the future. And it's going to be exciting to keep covering one of the most interesting and exciting companies in the world. That's it. Thank you for listening. If you got to 21 minutes, leave a comment below. I wanted this to be 15. I was like, oh man, I wanted it to be 10. But I was like, there's no way I'm going to get this in 10. If you actually got to 21 minutes, leave a comment below. The comment should be plastic cup. You can use plastic cup in a sentence somehow. Plastic cup in a sentence. That's how I know you got to the very end. Thank you guys so much for listening and watching. Please subscribe to dailypalantir.com/subscribe. My free email newsletter every day for Palantir. And Twitter, Dan Ives, 4:30 p.m. or 5 p.m. Eastern Standard Time, Friday. It's going to be fun. Check out Twitter in the description, and I'll see you guys there. Thanks so much. More coverage coming up in the next coming days. I'll see you in the next one.